Welcome to our webinar number 3 in the series. We've already had our previous 2, all about future-proofing your business and wealth. You've got myself as your host, Paisley, one of the directors here at Prime, overseeing our private client tax compliance team. We've also got Glenn joining us again. Glenn is the managing director of our Prime Wealth division. IFA, here to answer any questions, go through anything when it comes to a wealth perspective. And finally, we also have Andrew joining us as well, who's our inheritance tax and trust specialist, who joined us at the start of the year. So we'll be talking us through elements of that in relation to this webinar today. Firstly, we're going to move into the Finance Act. Major changes. Andrew, do you want to talk us through and set the scene on this part, please?
Yes, absolutely, Paisley. So if we all take a step back and see what's been happening, is previously, that's prior to the changes that were introduced in November last year, we had a system where 100% business property relief and agricultural property relief acted virtually as an exemption. And now we've got a system where you've got an allowance, not, if you like, an exemption system of £2.5 million per person. And that's in connection with the combined value of business property and agricultural property held in an estate. Now, this allowance refreshes every 7 years. And the first takeaway to take from that is because it refreshes every 7 years, and when the relief is exceeded, the relief is limited to 50%, this new system is basically designed to tax. It's basically designed to generate revenue. Now, that's not going to be, if you like, revenue as regards lots of people, as it would be in connection with PAYE. It's a very targeted tax, and it's targeted on the people who have agricultural property or business property relief over certain values.
Interesting. So, Andrew, can you tell how does that work where, say, the wife's totally involved in the business and the husband works outside of the business? What happens when she passes away? You know, the general pattern these days is for the surviving spouse to receive everything, so everything left on second death. So how does that work then from the other spouse, especially where young children are involved, and that means they may benefit from spousal exemption?
Now, that's a really good question. It's actually one that was raised with HMRC as we went through the consultation process with them. And yes, it's a very good point. And belatedly, they introduced a relief so that there's a spouse who previously didn't benefit from relief, when they have the assets in their hands following a death, effectively the relief doubles up. So they did think about that.
Oh, that's nice and generous. So if we move forward then, should we take a look at some of the transitional rules?
Transitional rules are really important. And as ever, it's the devil is in the detail. So you had a number of special rules which related to trust, which were set up before the 30th of October 2024. And imaginatively, they're called pre-commencement settlements. Now, these are really important, and they're important because they all have their own £2.5 million allowance per trust. Now, that will get cut down when the trust actually gets to its first 10-year anniversary date. That's by reference to the date that the trust was actually created. And it will get trimmed down to the value of the property held at that time. But it's very, very important to keep these trusts going. So they are valuable. So that's the first really important takeaway to actually add here. Now, there's a whole range of other trusts in the relevant property trust family. That's basically discretionary trusts, which had to be considered. So there's an awful lot of legislation that's been written about them, but in practice they have only limited impact because only a relatively small number of the population of trusts actually fall within those categories.
Interesting. So can you just tell me what the impact of all of this is, Andrew?
No, I can certainly do that. I was fortunate enough to be involved in the consultation process for the ICAW with Inland Revenue. A very interesting process. And one of the factors to draw out from this is that a lot of the information was actually released relatively late in the day. So if you remember, I said that we had the changes announced in November, and it wasn't until February, late February, that there was a technical consultation actually issued. Now that document contained a number of useful pieces of information, but also some rather worrying aspects. And part of it was the special rules, which I've highlighted here, relating to valuation discounts, which would effectively be negated under some of the original proposals. This would be the case where you had a settlor set up a number of trusts after the November 2024 deadline. And the effect of them would be to link all these shareholdings together. So you wouldn't get the full benefit of the valuation discounts, which you would normally expect to get in the individual trust. Now, what actually happened was very interesting. Representations were made to the Inland Revenue, including by the ICAW, which said that this type of legislation simply wouldn't work. And the reason why it wouldn't work is actually really simple. So if you have settlements set up by the same settlor, but say for different branches of a family, in order for you to group together all that information about the percentage of shares actually held and undertake the valuation rules, you have to have communication between different parts of the family. And certainly in my experience, that isn't actually always the case. You get some families where they're very reluctant to share information, and for that very same reason, it wasn't considered to be a practical solution. And as we'll come on to see later on, the fact that those rules weren't introduced is a really quite important planning point that we need to take into account.
Great. So what is the impact?
Well, the first thing is that we need to go and jog back in time. The traditional approach with planning of this nature often would be the patriarch or the matriarch who owned the important shareholding, let's say, in the business. They would aim to retain their shares for as long as they could, simply because they knew that subject to proper planning, they could benefit from 100% relief, which wasn't going to be limited. And then when they passed, it would mean that the value of those shares would get a step up in value base cost for capital gains tax purposes. So there's really no incentive, if you like, for succession to be considered and to take any sort of lifetime planning forward. So the net effect of that is that people have got to start looking at planning opportunities on a regular basis now. You can't leave it to the final furlong in the hope that everything will get sorted out. You need to do your planning on a regular basis and take advantage of the reliefs that are actually available to you.
Presumably, it's still a tricky decision to make because donors will have to weigh up the capital gains tax costs involved in cases where the 50% inheritance tax relief will apply.
Well, that's a very, very good point. You're going to have to do a assessment of what's going to be the consequence. Should I make a gift of these shares? What's going to be the consequence if I should retain them? To a certain extent, lifetime planning is still going to come out on top if it's the intention in the family to retain those shares. It becomes a lot more difficult if there's going to be a planned exit at some stage.
Okay, so presumably the real question with all of this is how to ensure that the business can meet those inheritance tax costs over what could be a protracted period of time.
Yeah, but absolutely right again.
Yeah.
It's, I think one of the things that may have escaped people's attention really is because this is going to be a continuing process of having to reduce as far as possible the value of the inheritance tax in the future, simply because it could impact on the viability of the business. It's going to be something that has to be considered in terms of how is the business going to effectively pay the tax. And so that becomes a very important consideration that people have to take into account.
Okay. Should we have a look at some lifetime strategies?
Absolutely. So the first point is really fairly obvious in a sense, is you have to check that you actually qualify for business and agriculture relief in the first place. Now that might sound a little bit odd, but there can be situations, as we'll come on to later on, where you expected you were going to benefit from business property relief, you don't. And so it's going to be really important, even for those businesses that fall below the £2.5 million limit, that they actually do qualify. The other aspect, again, is something that I think you'll be touching upon later, Paisley, is to make sure that you don't have too many non-trade related assets actually held, say within your company or your business. These are called accepted assets, and it would have the effect of limiting the availability of business property relief, which is a really important consideration. In fact, I think we're going to touch upon the issues related to holding too much cash, which can be a very important aspect. The third point is, if you've been given an allowance, make sure you use it to the maximum benefit. So if you know that you've got 100% allowance that refreshes every 7 years, please make sure you use it rather than leave it all to the final last knockings. And the other aspect, which again is slightly different onus, if you remember, we were saying a lot of people before used to hang on to their assets to death in the hope or expectation of getting 100% business property relief, and then getting a step up in value for capital gains tax purposes. What we've got to do is we've got to maximize 100% relief allowances within the family, and that's going to have some knock-on effects as regards the way that the business is run, which we'll touch upon later. We also have to think about how best to deploy trust to protect wealth for future generations. Now, I know that trusts aren't really universally loved and liked by everybody. To a certain extent, they have to be considered almost like a tool, how best to reduce the family's exposure to inheritance tax rather than something automatically to go in. But they are an important planning tool. Now, this is a very important point. It's, in fact, two very important points are going to come up. This particular important point is to make sure you take advantage of share valuation discounts. And we'll touch upon this again with some examples. And the final point, which is one I actually am totally in favour of, is that senior members of the family, they have to have their needs met. And that's an aspect that Glenn will be touching upon later on in the webinar.
So let's move into just having a look to see whether you actually check that you qualify for business relief. So you'll see here we've got a typical scenario. So P&A Enterprises Limited. Currently they have a company, 40% trading income coming in with 60% worth of investments. Let's assume that P&A Enterprises is worth around 2 million. Would you assume that that would mean that the shareholders should simply ignore the BPR changes? Well, the answer to that is no, because in this instance, the company does not qualify for business relief in the first place. And it's because it's not a company that is wholly or mainly trading due to the level of the investment related aspect of the business. As a result, no BPR, in this scenario, and the full value of the shares would be taxable on death. If we move into then, going back to what Andrew said, looking at the accepted assets, which generally gets forgotten about, in this instance, we've got a company worth 12 million. What's the impact of holding these types of assets? You know, in this scenario, you know, we would assume that the company's wholly or mainly trading, so would be looking at business property relief being available. But those accepted assets can actually have an impact. So if we look at the cash element, cash can be a contentious asset and can be treated as being excluded from relief where it's not required for the current or future purposes of the business. So it's really important to record within the records of the company, etc., that why you need that surplus cash for the business. So looking at supporting evidence to substantiate that. You know, an example might be you're looking to purchase a business to operate from. All of that evidence works towards justifying why there might be cash on account. Investments as well can also be a tricky area. You know, why they are clearly not required for business purposes, we'd then have to look at excluding them under the accepted assets. So it's something that has to be looked at in isolation with the BPR side of things. In this scenario that we've got here, if we assume that the cash and the investments are all accepted assets, what would happen from a BPR perspective? We'd have to actually restrict what's there. So what you would automatically assume, you'd get the 12 million, it's BPR, it'd actually be scaled back to 8 million in this case. So that £4 million sitting in investments would not attract any of the relief over the allowance. If we move into then looking at maximising allowances within a family, and Andrew touched on this as part of the strategies, good practice is generally looking at it for BPR and APR purposes. One way is to make sure that we've looked at it as far as possible for the business. So the first step being checking that you're actually qualifying. It makes a lot of sense then looking at the shareholdings, because it's looking how to spread those shareholdings amongst the family to make sure you're maximising the allowance that each person has available. This is a great tool for ensuring to ensure and to be able to spread that BPR allowance within the family as a whole. One thing that you do have to watch though is you have to make sure that the company can continue to operate as expected, and the governance of the company through the shareholder and the wider family arrangements are also looked at. So it's not just a question of just spreading all. You need to make sure everything is considered within the articles of the company, etc., and that it's all able to continue as normal. Andrew, would you like to take us through a scenario if we were to look at this in practice?
No, absolutely. So you make a very good point earlier that you've got to have things like shareholders agreements in place. You may well decide to have voting and non-voting shares, for example. The whole way of governance in the family business will need to change. And that's driven by a number of factors. And one of the most important factors is going to be the amount to maximise the availability of the £2.5 million allowances. So I'm not expecting people to shout out, and I couldn't possibly hear you if you did, but if you look at this scenario, West Midlands Enterprises, which I think is still owned by, no, it's not, it's father and mother. So father and mother 40% and mother 9%. So you've also got 3 adult children, and you've got some bear trusts. They're a bit like a nominee arrangement, which has been set up by the grandparents in connection with their grandchildren, probably something to do with payment using Alphabet shares to meet school fees. So if you just take a step back at that and see what we've got, well, I think we've basically got 9 shareholdings. And then if you work on the basis that the maximum allowance per in this scenario is going to be, I think, 22.5 million. That's more than enough in all likelihood, to cover the potential IHT related exposure. It may need some fine tuning going forwards. So if you take a step back and have a look at this, this is really, if you like, a little bit of an over enthusiastic generation of allowances to have within the family. We need to have a system by which the business can carry on. So we need to have a workable shareholders agreement. And we also need to have, I would suggest, voting and non-voting shares. So those members of the family whose allowance we're relying on to a certain extent, but who aren't actively involved in the business, they have no non-voting shares, so they can't actually get in the way of the profit generation that's required for the family business.
How does this work for valuation discounts then?
Well, this is something Paisley and I know an awful lot about as a result of our recent experience. In fact, there's a brilliant help sheet, ACCA help sheet 167 and 168. 167 deals with valuation discounts that you could expect for minority holdings in a trading company. And what happens if we could just move to, say, the next slide, I'll show you what happens with these relative holdings. So all these minority holdings get discounted, and I've applied the effective rates here. So I've applied in connection with a 49% holding, and I'll explain how I got to that. You would expect to have a discount of between 30 and 40%. Then if you go right to the bottom as regards to a holding of shares for the grandchildren in the Bear Trust, you could expect a whopping great 60 to 75% discount. Now, the reason why I said you could only, I was interested in the 49% discount, is that the holding, if you remember, of father and mother was 49%. And this is called related property. So the values have to be taken together, and then it's a pro rata allocation of what a 49% holding would actually qualify as. So if mother was 9%, you would expect her on her own to have had a 55 or say 50% discount. As regards that combined holding, the level of discount under the special related property rules which apply for husband and wife and registered civil partners, you would expect a 30 to 40% discount. So if you couple together the need to maximize exemptions as well as the need to effectively reduce the value of the shares through the use of fragmentation planning, you can achieve very valuable savings.
So we move into will planning. How
Oh,
can
absolutely.
that?
No, absolutely. Will planning. I don't know about anybody else, but I'm awful. I think I last did my will 15 years ago, and it's totally out of date. It includes some brilliant tax saving ideas that worked then, but probably don't work now. So it's something I've definitely got to revisit. But seriously, as regards the current situation, very, very important to review your wills at least every 5 years. And there's a particular issue that you need to take into account. A lot of people don't really read their wills in depth, but quite often you might have a clause in there, especially for business owners or people with interest in farming businesses, which automatically sorted out their assets in their estate to go to different people, trusts, and so on, by reference to the measure of relief that those businesses or business assets would actually access under the inheritance tax rules. Well, the rules have completely changed now, and you could end up in situations where you didn't really know where assets were going because of the operation of the new rules. So it's something that's really important to review your wills to make sure they're going to operate in the way that you want them to operate. Now, in terms of double dipping,
There we go.
In terms of double dipping, is simply to flag it up that there are various specialist schemes, if you like, or special ways of dealing with assets. A double dip arrangement was a situation where typically under a trust arrangement, assets would be qualifying for, say, business property relief would be left to the trustees, and if you like, investment assets would be left for the benefit of a surviving spouse. The assets left for the benefit of the surviving spouse would benefit from the spouse exemption, so no tax payable there. As regards the business property relief assets, in the expectation that you had 100% relief, there would be no charge to inheritance tax as regards the assets going to the inheritance, going to the discretionary trust. The trouble is, it's not clear to me at the moment how these arrangements are going to work as a result of the new changes. Net effect of that is, if you've got an arrangement of that nature, I certainly would take professional advice, and it'd be reasonable to go back to the let's say the tax advisors or legal advisors who arrange that arrangement or put that arrangement into effect, just to check that they're still going to work in the way that you would hope and expect them to work. Now, in terms of other ideas, in terms which you could adopt, very important to have a flexible will, I would have thought. We're going through an immense period of change at the moment. We've had immense changes as regards the inheritance tax rules for agricultural property relief and business property relief. In all likelihood, we're going to have very major changes coming on the horizon in the relatively near future, with the change or likely change in the Prime Minister. So important to be flexible, and a testamentary discretionary trust is an absolutely excellent way of maintaining flexibility. It gives you a 2-year period for the assets when they go into the discretionary will trust, and for those assets then to be passed on by the trustees to a beneficiary, and it's treated as if those assets were given to those individuals by the person who died. So very, very flexible. The only important thing, which again, something Paisley and I have been considering recently, is there can be capital gains tax consequences to this. So it's very, very important to take professional advice when assets are being distributed from this type of arrangement. Now, in the past, people, just in the same way that they didn't fully put in place a succession plan for passing on shares in the family business, they didn't actually take out a huge amount of insurance-related cover, because they would think there was no need, because it was going to be exempt and it hence no tax payable. So Glenn has taken us through various options as regards insurance cover arrangements, such as whole of life cover, and there are actually some specialist and very useful arrangements that Glenn will be able to take you through.
Great. Handing over to you, Glenn. One thing I will just say for anybody that's listening at the moment, if you've got any questions so far, please post them in the Q&A, and likewise, as Glenn's talking, we'll try and pick up what we can at the end.
So, can everybody see my slides? Okay. Paisley, are those slides on view?
They are, yes, I can see them, Glenn.
Perfect, perfect. Just double checking. Thanks, Rick. Good afternoon, everybody. Yeah, my name is Glenn Callow. I lead the financial planning arm of Prime Accountants Group. So effectively, that's the FCA regulated arm of the business. So all matters, pension, investment, insurance, anything effectively under the FCA, auspices of the FCA. I did go through the use of whole of life insurance, as Andrew said, as an inheritance tax provision, which is a policy in our previous webinar, which I encourage you to watch the recording if you haven't seen that yet. That's a policy which is written on a joint life, second death basis to provide for inheritance tax where you haven't mitigated inheritance tax via other strategies. What I'm going to run through today is what we typically put in place for our business owner clients. So pretty much everyone we look after is either in business or has been in business in the wealth business. So it's quite a specialist area. Ultimately, it starts off with a conversation. What do you want to happen with your business? It's the ownership and control of the business, and what do you want to happen for your respective families? What value do you want in their hands? So we're having a discussion. I mean, typically the surviving shareholders would prefer, so one shareholder passes away, the surviving shareholders would prefer to assume full ownership and control of the business. And typically, they would want their family to receive a cash value in compensation for the shares which they no longer own. And ultimately, that often is desired to be a clean break. So family get their cash, business continues, and the control of that business continues. And more recently, they would like some cash available for inheritance tax provision, as Andrew and Paisley have been explaining. Above certain limits, inheritance tax now does become an issue for business owners. Effectively, we would put into place a shareholder protection arrangement for that business and those shareholders seeking to achieve the above. So first of all, do you need a shareholder protection arrangement? Well, few things to consider. Could the surviving shareholders actually afford to buy the shares? Is there sufficient wealth in the family, or does the business have sufficient wealth within itself to buy those shares and potentially cancel them following a company buyback of shares? And even if it is an option, is there a guarantee or any agreements or anything drafted which ensures that does happen in a timely way and at an agreed value? Can you guarantee the surviving shareholders want to buy? Can you guarantee the recipients of the shares, i.e. the family, want to sell? And is there a fair price agreed? Is there a mechanism for that price? Because you could easily end up with conflicts between the surviving shareholders and the family. All of this can be achieved through a shareholder protection arrangement, which helps to protect the long-term stability and the continuity of the business and the financial position of the respective families. So peace of mind for all and funds for IHT.
Great. Do you have an example you could walk us through, Glenn?
Yeah, so I've got a fairly simplistic example, which hopefully is useful for the purposes of this presentation. I would say that, specific individual and personalised advice is always required. So no action taken on the back of this, but, in this simplistic example, we've got two shareholders who are 50-50 shareholders of a privately owned trading business. If one of them passes away, typically their will would leave their shares to their family, typically. So now we have the surviving shareholder is now in business with the spouse in this example. Potentially, they're the owner of the other 50% owner at this point in time, which isn't always ideal. We would eventually, the company, to mitigate that issue, would take out a life insurance policy. Proceeds on the life of each of those shareholders. Should one of the shareholders pass away, the life policy proceeds pay to the company, and then there are sufficient funds in the company to purchase the shares from the family. So you can see that flow through. So life insurance policy paid into the company, cash paid to the spouse who has received the shares via the deceased shareholder's will, and those shares are then sold to the company, leaving the sole surviving shareholder with complete control of the business and able to continue after what would be a disruptive time, and the surviving family have a nice pot of cash in compensation for the shares that they no longer own, all through an agreed mechanism. And in a very handy way, we've been putting these policies in for many years for our business owner clients. There's actually cash available now, because where those shares exceed 2.5 million, there'll be inheritance tax to fund significantly high value businesses have got a lot of tax to pay, and there just might not be liquidity around in the family or in the business to buy that, to kind of facilitate that. So it's an added benefit, which for those that had planned previously was already catered for.
Great. Are there different ways you can establish these policies?
Yeah, there's two main ways to establish the arrangements. You can have company-owned policies, and that's the example that I've already run through. That's where the company pays the premiums, the company receives the claim proceeds of the policy should a shareholder pass away, and then the company uses those funds to purchase the shares from the deceased estate. Another way of arranging this, which we don't have time to cover today, is an owned life in trust, where the shareholders take out the policies themselves and pay premiums, with proceeds of those policies paid to the trust, and then the beneficiaries of the trust are the fellow shareholders. Those trust funds, once they pay out, are used to purchase the shares off the deceased estate and the family, and the business can continue.
So what do you have to consider, Glenn, in order to provide advice in this area?
So first of all, the cover level. So there needs to be a company valuation. Obviously, our colleague Adrian in the forensic department is well versed in company valuations and minority discounts. So that's the first thing. What exactly is the risk? What is the value? What is the IHT value? And what, ultimately, what is the value of those shares? You want to then take some legal advice. We would suggest to one of our legal partners to review the shareholder agreements and articles, and essentially effect a double option agreement, which allows for all of this to happen. What that means is that double option agreements basically typically would say, if the family wish to sell the shares that they have received, or the personal representatives, or if the surviving shareholder or shareholders want to purchase those shares, that has to happen. So it's a double option agreement. It's not a legally binding agreement. So, but if either party exercise that option, which invariably they will, then the transaction would take place. So everybody is protected. You need to think about the term of the cover. How old are the shareholders? What's their plans for the business? What's an appropriate term to kind of cover, because we want to make sure we've got plenty of headroom there, so we're not going back and reinsuring at a later stage at a higher expense. Need to consider any health issues that the shareholders may have. We will have to submit that to the life company and the insurance providers for them to take a view of the risk of those. Obviously, age is a factor, smoking is a factor, health conditions and any medications they might have, equally family history. Typically, shareholder protection is put in place on death of a shareholder, but you can also include critical illness. That does become somewhat more expensive, because you're far more likely to be diagnosed with a defined critical illness prior to the age of retirement, 65, than you are to actually pass away. So that has to be a kind of a cost benefit analysis, and again, part of the advanced process. And you need to review those sums assured. Has the business significantly increased in value over time? Should we be or has it gone down in value, and should we be reducing the level of cover? And ultimately, if you are underinsured, an additional policy would need to be taken out at future points to make sure everybody is protected, and the family are well compensated. We can, at times, if it's a high growth business or something that's on a growth trajectory, we can add indexation to the policies. So we might have a certain sum of cover initially that increases by up to 10% per annum, which you can take off that indexation at a later point in time. But the benefit of that is you are not medically underwritten every time that policy increases by 10% in that example, and that can protect from maybe not being able to get that insurance in 5 years' time if one of the shareholders has got a medical instance or otherwise that would stop them, that would be prohibitive. So really, that's just kind of running through that shareholder protection option. It's not the only option available for business owner clients or for pension holders, etc. So there's a real potential mix in the advice process, and I'd encourage you really potentially to reach out to us and see how we can help.
Thanks, Glenn. That's been really helpful. And thank you, everyone, for listening. I've got a couple of questions that we're just going to run through. So I'll start with the first one. We've talked a lot about shareholders agreement in the webinars. Specifically, splitting shares into non-voting and voting shares, is that necessary? I don't know if you want to pick that one up, Andrew.
Yeah, absolutely. It's very much a question of preference for the family involved. But it's actually become quite a popular point of discussion when talking to our clients, because, as I was saying, we need to actually introduce the maximum number of allowances that we can have in order to mitigate the charge to tax. So it's spreading the shares or value within the family generally, but also it's very important that the business continues to operate. And this has led some, not necessarily all families, to consider the possibility of ensuring that voting shares rest with the people in the family who are actually running the business, and also then to ensure that there is, if you like, a shareholders agreement to add extra security. It's just basically a form of wider governance, because we can't leave it to the end, if you like, until the patriarch and the matriarch passes, because we need to have a, a continuing succession plan, which is going to run for a number of years.
I've got another one. Well, it's probably more so from me than anything. I think one clear takeaway I had from that, Andrew, is I need to update my will, in all honesty. And I think a lot of people probably never think about it. Like you said, you should do it every 5 years. What's the best approach to this?
Well, it's a question of preference, isn't it? The traditional approach is to basically have a series of gifts that sort of mechanically you go through, depending on whether or not the person has survived, or whether it's caused the gift, if you like, to lapse. But my choice, so I'm going to push it, like you, I need to update my will. My choice will be to use a testamentary will trust. And what I'll do is I'll leave a letter of wishes to the executors, and I'll say to them, you need to take these various factors into account, but I'm not going to limit or tie their hands. It will be to members of my immediate family, the older children and my wife, obviously, to decide what they want to do. But that way round, I don't have to change it every 5 years. Provided nothing major actually happens to alter that view, it means I can do it once and then I can tuck it away and forget about it.
So it's a great tip there, Andrew. It's something that I'll probably definitely consider. I think obviously we've got a lot going on within the government and potential budget on the horizon as well. Can we expect future changes, do you think, to do with business property and agricultural property relief in the next 12 months?
Well, the trouble is, there's no certainty about anything, is there, really, at the moment? A huge period of change. But if you remember, I was saying that the Finance Act 1988 was when we actually slipped to having a 40% fixed rate of inheritance tax. And prior to that date, there was a graduated rate that went from 30% to 60%. If what we hear suggested in some quarters in the media is correct, it's quite likely that there'll be heavy demand for raising revenue. And on that basis, it's quite likely that changes may be introduced which could have the effect of making it more expensive to actually pass on wealth in the future. There was also talk about completely redesigning the tax. I think a sort of prudent approach would be, if you were minded to make a gift anyway, at the moment, but you haven't quite decided whether you were going to do it now or maybe in 2 or 3 years' time, it would probably be sensible to bring that forward, because there is so much change underway. And the other aspect is one of the, which is a related point, has been a suggestion in the media that there might be an alignment as regards capital gains and income tax rates, which would be a major change. And it would be quite important for people to take into account if they want to consider this further as regards to their own plans, say for realization of a business or whatever. It would be important to take that quite seriously at the moment, because change at the moment seems to be a constant factor in our life.
You never know what's on the horizon, really, do you, at the minute? So thank you for that, Andrew. I think I've got one final one for Glenn. What should we do if we want to get some advice for us and our business, do you think?
Yeah, I think it's obviously reach out to us. Our contact details will be in the slides. As we've kind of alluded to and mentioned in the presentation so far, really this is a multidisciplinary approach, where you need, decent tax advice that understands personal and corporate taxes and the implications of actions. Financial planning advice, understanding what gifts we can afford to make and what does that do to the lives of the donor. Are we leaving ourselves short in any way? And obviously considering things like pensions, and there's a whole range of assets that need to be thought through. And so there's tax advice, there's regulated financial planning, and then as we've mentioned today, the requirement for estate planning, will advice, trusts potentially. And so it really is a multidisciplinary, come and talk to us, let's understand where you are, probably meeting myself, yourself, Paisley, Andrew, whoever the right mix is initially, and at a point bringing in the legal advice as well, because all needs to be singing off the same hymn sheet. We all understand the objectives, we all understand what we're trying to achieve, and we all understand the actions we're taking now and what we might do in the future. There might be certain actions that we're happy to do now, and then we'll look at that again in 3 years' time, 5 years' time, as we've gone down the track a little, and other variables have become a bit more understood.
I think that's the key takeaway for me, is don't bury your head in the sand and look at what your position is, and then seek advice to try and establish what you can't do, all those types of things, isn't it? So it is really to speak to professionals and just see where it takes you. Great. Thank you both. Thank you everyone for listening. I hope you've enjoyed the series to date, and if you need anything, you can reach out to us on our email addresses, phone in the office. So thank you, and I hope you have a good rest of your day.
Thank you.
Thank you.